Time for hot picks in Canadian mid-caps. Our guest has Boyd Group, a North American chain of collision repair centres, as his top pick. We're joined by Graeme Kreindler, Associate Portfolio Manager at NewGen Asset Management. Thanks very much for joining us, Graeme. Really appreciate it. Just remind us about Boyd Group, a massive operator in North America.
Yeah, thanks for having me on the program, Andy. It's great to be back. So as we talk about our picks here today, starting off with Boyd Group, as you mentioned, it's the only way to play collision repair within the public market. And we like the stock because we like to find stocks that are at inflection points. And the industry's been in a bit of a challenging spot. The last 5 quarters, Boyd Groups have had negative same-store sales growth, and that was driven by higher insurance premiums and used car prices that were coming down. This basically made things more expensive for consumers to fix their car, and they were holding off. Now, what we're seeing here is the industry exit this downturn. Boyd finally had positive same-store sales growth in their last quarter. The trend continues to improve in October, so we like where things can go from an organic growth standpoint. The other thing is Boyd also completed an acquisition of another chain called Joe Hudson. It was a $1.3 billion US acquisition. This is a very fragmented industry. The top 3 players, Boyd being one of them, only control about 25% of the industry. So we like to see Boyd do these types of M&As, these bigger deals, and roll up the industry. And what that all leads you to is the management team of Boyd has a plan to double their EBITDA by 2029. We think between the organic growth, the M&A strategy, we think it's very credible, and we think things will continue to trend in the right direction for them.
We have heard cars are so full of sensors now that even a minor accident can lead to scrapping of the vehicle. Are there implications there for Boyd?
I don't think it's necessarily a scrapping of the vehicle, Andy. I think what you're seeing is the average cost of repair go up over time. And those costs of parts and labor is ultimately a pass-through for Boyd. So that actually can help to continue to lift that same-store sales growth that I was talking about. So, complexity in cars is going up. And ultimately that continues to create opportunities for the company, as well as things like scanning and calibration of these sensors, which is a higher margin revenue stream for them. You ultimately have to get that back working in order, not just sort of patching up the paint and the parts.
Your next idea is Extendicare, and of course senior housing, senior care, a growth industry.
Yeah, you said it, Andy. I mean, you look at the demographics within Canada, the cohort of Canadians aged 85 plus, that grows at about 4% a year. So that's a backstop for organic growth. Now, Extendicare is involved in long-term care facilities, which you mentioned. There's huge wait lists. There's a large shortage. They're also involved in home health care, so sending the healthcare practitioner to your home. That's growing at about 10% a year. And when you think about the shortage in long-term care, getting care in the home is basically triaging the shortage that we have in these longer-term care facilities. So we think that Extendicare will continue to grow in excess of that industry growth rate. They also completed an acquisition of a company called CBI, which is in home healthcare. That grew their employee base to by over 65%. This takes the composition of Extendicare, its profits, more than 50% of its profits are now involved in that higher growth, higher margin home health care. And I think a lot of investors still consider Extendicare to be involved in the real estate side of the business. We like companies when they're in the middle of a transition, when they're not yet fully understood, exiting or entering into this period of higher growth. We think it's a very exciting time for the company. The other thing is they haven't raised their dividend in 10 years. They raised it for the first time last year. We think with this new positioning of the business and how their balance sheet's positioned, we think that they can continue to pay out a strong and stable dividend moving forward.
Yeah, the dividend right now about 2.25%, I believe. So not too shabby.
Yeah, not too shabby, but I think the important thing is you like to see track record of growth over time. Raising the dividend for the first time in 10 years, that's certainly a signal, and we'll see how that trend's going forward.
And you said that half of their profits roughly now coming from this home healthcare service business.
Yeah, that's correct. So pro forma for this M&A deal that I mentioned called CBI, so they're now a bigger player. They are in the faster growing home healthcare segment than they are on the LTC and the real estate side of things.
And maybe we could just throw up a 10-year chart for Extendicare, because of course during COVID, those stocks were weak for a while. People concerned about safety in senior residences, etc. But that stock came roaring back.
Yeah, and I think what a reflection in that is the improved balance sheet over time. You've seen operating metrics and the occupancy in long-term care normalize, and then you're seeing this very strong organic growth in home healthcare that I mentioned. Putting up 10% or higher versus what's normally kind of a mid-single-digit growth business. I think that transition of getting a new investor base to look at the company as it reshapes itself. I think you're starting to see that bear fruit in the market here.
And finally, you've got a nice diverse set of ideas for us here. Highlander Silver, what are they all about, and why have they caught your attention?
Yeah, in this market environment, Andy, I'd be remiss if we weren't talking about commodity stocks here. And I think the big question for investors, you look at the price of gold, you look at the price of silver, they're at all-time highs, and you're worried, have I missed the move? But we see opportunities within the actual equities that have significantly lagged the commodity. I mean, you look in the last 6 months, for example, the price of silver is up about 150%, but the equities themselves, if you look at the Silver Miners ETF, that's only up 90%. I say only 90%, but significantly lag the commodity here. We turn to Highlander. This is a TSX silver miner developing assets in Peru. I think the first thing you want to look at with a commodity stock is the people and who's backing the company. And this is backed by some of the most successful and biggest investors in commodities, names like Eric Sprott, the Lundin family, and Augusta Group. So we have a lot of confidence in the team there, and we think that the company's in good hands. When we look at the company itself, involved in Peru, which is a good mining jurisdiction, they have 2 assets. Their flagship asset of San Luis, that's one of the highest grade precious metal mines in the world. And then they recently completed an acquisition of a company called Bear Creek, and they got the Corani Silver Project, which is also in Peru. That's one of the largest permitted silver projects in the world. So some really big optionality within silver, within this company. But the rub is really within the valuation. And going back to the equities lagging the commodity, Highlander Silver trades at about 30% of its net asset value. The stock's around $6. Its peers trade at about 60% of their net asset value. So that would imply that the stock could double. Now, this is all being priced off of a $40 US silver price per ounce. Silver right now is trading at closer to $90 an ounce. So, let's say put a $80 silver price on the net asset value of the company, we think there's potential to double again. So lots of torque, lots of upside in this commodity bull market that we're in. And we like the backing, we like the asset package, so we think this is a great opportunity. The other 2 things are the company's going to look to list on the New York Stock Exchange, and also we think it'll get included into some of these mining indexes, which will help continue to improve trading liquidity and get people more access to be able to get involved in the name.
Thank you. Thanks very much, Graeme. Really appreciate it.
Thanks for having me.
Graeme Kreindler, analyst at NewGen Asset Management.